Hello and welcome to the Legal Super podcast, where we make super simple, practical, and also interesting. My name is Jess Empson, and I'm really proud to be the strategic partnership lead here at Legal Super. I'm fortunate enough to have over 25 years experience working in both financial services and the superannuation industry, and I have helped lots of people navigate super. Today, we're diving into a topic that's really interesting, tax in super. So we're going to look at why super is taxed so efficiently and also how you can actually take advantage of it. I'm joined today by Guy Mahony. Guy is one of our strategic wealth advisors here at Legal Super. Guy has also had over 25 years experience within financial services and the super industry in Australia. He's helped thousands of Australians navigate the super system. Thanks for joining us today, Guy. Great to have you.
Great to be here, Jess.
Okay, so Guy, let's start at the beginning. Why does super get such great tax treatment in the first place? And how does it all work? How does it happen?
I think the most important thing to remember is that super is probably the most tax-effective place for the majority of people who are ever going to be able to invest their money. The reason super gets such preferential tax treatment is the government wants people to be putting money into their super so they're not so reliant on the age pension when they come to retire. So super's got a lot of tax benefits associated with it. It's, for generally most people, it's a lower tax rate going into super, only 15%, generally speaking, lower than most people's marginal tax rate. It's then taxed at only 15% on what you earn on it. So if you had assets in your own name and you got income, rent or dividends from that, you'd be paying your marginal tax rate on that. In super, you only pay 15%. And then when you come to retire, for a lot of people over 60 and drawing down on their super and also what they earn on it, there'll be no tax at all. So it's really three ways. You tax lower on it going in, tax lower on it when it's earning money. And then for most people, when they're over 60, what they earn on it and what they draw down from it's going to be completely tax-free.
Okay, guys, so we know that super is designed to be tax-friendly. How exactly does that work in practice, in real life?
So there's lower tax on the money going in through contributions, lower tax on what you earn on it. And then once you're over 60 and you're retired or over 65, there's no tax on what you withdraw from it or what you earn on the underlying assets either. So with contributions, that money going in, you're only being taxed at 15% rather than your marginal tax rate, which for most people is considerably higher than that. Also, in what you're earning on the underlying assets, so if you've got shares, property, infrastructure, all those kind of things that we invest people's super in, you're only paying tax on up to 15% on the income that those things generate. Whereas if you held those kind of assets in your own name, whether it be a bank account or shares or property, you're actually paying tax on what you earn on those things at your marginal tax rate. Then when you come to retire, the tax benefits of super really ramp up because if you're over 60 and you finish work, or you're over 65 and regardless of your working status, what you earn on your super up to, in this financial year 25-26, up to 2 million, you're not paying any tax on what you earn on it. And you're also paying no tax on what you draw out.
Okay, Guy, that's great to hear the theory. But let's talk about using those tax advantages day to day. So what could listeners do to actually save tax using their super?
Okay, so the easiest way people can start saving tax with their super is to actually make some salary sacrifice contributions or tax deductible contributions, so making a lump sum contribution and claiming the tax deduction. In that way, for most people who are earning above $45,000 a year, their marginal tax rate is at least 30%, if not higher. So that money going into super is only taxed at 15%. So quite a tax saving for making those contributions. If you're then looking at what you're earning on the money that you've got in super, so on your super balance, your income and your investment earnings are only taxed at up to 15% as well. Whereas if you have those kind of assets in your own name, shares, property, your bank accounts, then you're actually paying your marginal tax rate on what you earn on it as well. So that really does influence the compounding of interest within your superannuation fund. Just makes it grow that much more. Holding those assets in super, much more tax effective.
So Guy, what about non-concessional contributions, so after-tax contributions? You want to just talk us through the benefits of those?
So these are contributions that you put into your super after you've paid your marginal rate of tax. So they actually go in and they don't attract the 15% contributions tax going in either. So the full amount that you're putting into your super actually hits your superannuation account.
So why would someone use this? What's the benefit?
For the majority of people, they would have already maxed out their before tax contribution amount. So that's probably normally the priority if you're earning an income to actually use up that before tax limit first. But then for people who want to get large amounts of money into super, because the limit for after-tax contributions is a lot higher than before tax. So when you've got large amounts to get into super through like an inheritance or maybe an asset sale, the government allows people to use a bring forward rule that allows you to put in up to 3 years worth of the after-tax contribution limit in one hit. So it really allows you to get large amounts of money into super in a short space of time. And that's really beneficial because if you're putting that money into super, if you're still accumulating, you haven't finished work yet, then what you're earning on that is only getting taxed at up to 15%. But more importantly, when you come to being over 60 and retired or over 65, that money for most people is not going to be taxed on earnings at all. So with all these things, both before tax and after tax, bear in mind there are caps in terms of how much you can put in, and you can be penalised tax-wise if you do go over the caps.
So thanks for that, Guy. I know that you mentioned contributions earlier, so it would be great to unpack that because I know it can be a little bit confusing. So there's different types of contributions. If you could just give us a bit of an overview of that, and also how those different type of contributions are actually taxed.
Yeah, so probably first to look at is before tax contributions. So money that you put into your super before you've paid your marginal rate of tax. So that includes what your employer is already paying. So your superannuation guarantee, which in this year, 25-26 is 12%. And then it also includes any salary sacrifice you might do or personal deductible contributions where you're claiming a tax deduction. So there's caps you've got to think of there. There's annual caps, but we'll talk about those a bit later. But you've got to keep in mind that the government's also giving people what we call like a catch-up provision to be able to, if you haven't used up the full amount of the cap from previous years, when you've been doing like salary sacrifice or personal deductible contributions or your superannuation guarantee hasn't taken up that whole amount, the government's actually allowing you to use 5 years previously of the cap that you haven't used to do in one hit. So it really allows people to do some pretty significant personal tax planning in one go. So I had a meeting with a self-employed high-income earner at a large firm about 6 months ago in the lead up to the end of financial year. And she had never put in money for herself into super in the last 5 years because she didn't have to, self-employed. So very quickly, it took about 10 minutes. We went onto her MyGov, had a look at her what's called carry forward of concessional contributions amount, which is a bit of a mouthful. But we looked at that and she had an amount there of $167,500. Now, really importantly, because she hadn't been putting money into super, her super balance was under $500,000. So she could actually make a tax deductible contribution of that whole $167,500. Probably gave her a tax saving of about $70,000, all for, spending about 10 minutes with me.
That's one lucky lady. She must have been very, very happy with you, Guy. And also it just shows the value and the interest of getting engaged in your super and finding these benefits out is so important, isn't it? That brings us to an important point, contribution caps. So what are the limits on the contribution caps? And more so importantly, what are the implications if someone actually exceeds those contribution caps and goes over?
So important to remember that for both before tax contributions and after tax contributions, there are annual limits. So in the current 25-26 financial year, that's $30,000 for before tax contributions, $120,000 for after tax contributions. Now, these change all the time. So always be mindful that what the limits are now, they will go up into the future. And if you do go over them, there can be penalty tax to pay, quite a bit of paperwork and administrative things that you have to go through with not only your super fund, but the tax office. So always best to be mindful of where they are. So catch-up rules may apply for contributing this way. Check your eligibility. But what it may mean is that if you haven't used up all of the available cap for before tax contributions in the previous 5 financial years, you may find you can actually put in well beyond the annual cap and really save yourself some tax.
Thanks for clarifying that, Guy. So I know I get this question asked all the time. So that 30,000 limit for concessional, does that actually include the employer contributions that people receive? So that 12% of their salary, is that included in the 30,000?
Yes, it does. So a really easy way to think about it is with an example. So if you're being paid $100,000 a year by your employer in salary and they're paying you 12% on that, so what's already going in as a before tax contribution is $12,000. So your available cap or what you have left available in the cap is $18,000. So that's how much on an annual basis you could actually put in as either salary sacrifice or a before tax contribution.
Okay, guys. So we know the money in the super account is invested. With the earnings, how are they taxed?
So during your working life and you're contributing money into super and it's growing, so that income, those dividends, interest, things like that are only taxed at a maximum of 15%. So for generally speaking, most people, that's significantly lower than what their marginal tax rate is. As you then come into retirement, so you're over 60 and you finish work or you're over 65 regardless of your working status, what you earn on it up to $2 million in this financial year, 25-26, is also tax-free on earnings, so completely tax-free. What that means is that if you are sort of moving towards sort of that end, you're coming towards retirement, you might be in your late 50s, starting to think about, is investing within my superannuation fund maybe a little bit more tax effective than I've been investing in my own name? So it starting to thinking about, if I'm holding assets outside of super, do I look at starting to import them into super? Because if I'm in my late 50s, going into my 60s, the accessibility of super may not be such a big issue for me in the near future. And it may mean tens of thousands of dollars more that you're earning through your super because you're not paying tax.
So let's talk about accessing the money in your super account before you turn 60. So, Guy, I know there's special areas where you can actually take the money out before you turn 60. Do you want to just explain how they work?
Yeah, so there's a number of reasons why you can take money out of super before 60. Those where you would pay tax at your marginal tax rate with a 15% tax offset for financial hardship and compassionate grounds, where you actually have to make an application to your super fund. Then there's also ways that you would access it without paying tax, which is via a terminal illness benefit, where it's been determined, unfortunately, that you've got a condition or an illness that's going to mean you're likely to pass away within the next 24 months. And then there's the First Home Super Saver Scheme, which is a bit of a mouthful, but it's where the government allows you to put in extra contributions to super before tax. So not the superannuation guarantee your employer is paying, but money that you would put in before tax on top of that. So through salary sacrifice or a personal tax deductible contribution. And that really enables you to put that money in, save a bit of tax on it. And then when you come to find that property that you want, that first property, you can draw that money out.
So with that First Home Super Saver scheme, it's such a great idea. So a good friend of mine actually used it to buy her first place in Richmond. So it allowed her to save $15,000 that she wouldn't normally have in her super account. And she was able to pull that out and actually use that to go towards paying for her first home. I really wish that that was around when I bought my first place. So Guy, what happens after you hit 60 years of age? I know that some really, really big tax advantages kick in. Do you want to just talk us through those?
Yeah, so for people who are over 60 and have either finished work or over 65, regardless of their working arrangement, the tax advantages to super are actually really huge. You do have to have satisfied a condition of release. So if you're between 60 and 65, that means you either have to have ceased an employment contract or you have to have ceased work altogether. Or over 65, regardless of your working status, you're actually going to be able to withdraw money from super tax-free. And you're also going to have your superannuation, the earnings on your superannuation fund be tax-free as well, up to a limit of $2 million.
So Guy, let's talk about transition to retirement. And I know that, again, we get lots of questions about this. Does transition to retirement, or TTR, as we like to call it, does that actually have a different condition of release?
Look, it doesn't have a different condition of release, but it's got a limited condition of release. So you've got to have reached your age preservation age for super, which for everybody now is 60. And what that means is if you can do it, at that point, you can open up a superannuation pension account over 60, and then you can draw up to 10% of the balance of that account tax-free because you're over 60. So let's say you were to put $100,000 into a superannuation pension account. In that first year, you could take $10,000 out, and you can use that to either, enable you to salary sacrifice a little bit more, or make a tax-deductible contribution, or really do with it whatever you want. If you wanted to pay it off your mortgage, whatever, it's free for you to do what you want to do. And you're not paying any tax on what you draw out.
So just on that no tax, and I love the way you're explaining this, does that no tax work if someone takes out a lump sum from their super account, so a lump sum of money? And does it also work if someone actually takes out an income stream from their super?
Yeah, so for all ways of accessing your super after 60, and you've satisfied one of those conditions of release, you don't pay any tax on what you draw out. So for both regular income payments or lump sums, you're not paying any tax. So not paying any tax on what you're drawing out, not paying on any tax, generally speaking for most people, you're not paying any tax on what you earn on it either. So it's really when those massive tax incentives of super kick in your retirement just at the time you really need it.
Most people don't realise that if their super goes to a non-dependent, such as an adult child or a sibling, so a brother or sister, they can end up paying quite a lot more in tax. So Guy, what can listeners do to plan ahead to make sure that they're actually not paying so much tax on their super?
So you're right. It's a topic most of us don't want to talk about. We'd all like to think we're indestructible. But the fact is, our super, we may have super assets that are going to go to someone. Now, if you leave your super to a friend, a sibling, an adult child, or the dog or the cat, it's likely that they're going to pay up to 30% tax. So to give you an example of that, if you had a super balance of $600,000 and it was all taxable, then if that goes to one of those people that we would class as a non-dependent, they'd actually lose up to $200,000 worth of tax. So that's money that's going to go to the Australian Tax Office rather than the person you really want it to go to. So to avoid this, you can look at drawing money out from your super and putting it back in as an after-tax contribution. And we call that a recontribution strategy.
So just to play this back to you guys, so in simple terms, once you've met a condition of your release, you can essentially take the money out of your super account and put it back in, just as long as that money hasn't actually come from an employer contribution. So it hasn't been a superannuation guarantee contribution. So if that's the case, then it's tax-free?
That's correct. It's a bit of a complex area, but a lot of people do require to use a recontribution strategy if they don't have a financial dependent anymore that they could leave their super to. So really worthwhile getting some advice, some information regarding it.
Let's talk about if they are financially dependent on you. What happens then?
Yeah, so if it's like your spouse or your young children under the age of 18, they're considered to be financial dependents. And usually speaking, they'll receive your super tax-free. So really important that you get the nomination of the beneficiaries for your super fund right. So you can actually select with your super fund who you want your superannuation monies to go to.
So with those nomination of beneficiaries, I know that you've got two types. So there's binding and non-binding. And I know, again, I get asked this question all the time. Do you just want to step us through the key differences between the binding and non-binding nomination?
Yeah, I guess the key difference is with a binding nomination, you have to update it every 3 years. So it just gives the trustees of the fund, in this case, Legal Super, that little bit more certainty that the person that you've actually nominated as a beneficiary is the person that you want the money to go to. So it just means that generally speaking, the person's going to, if it's a binding nomination, the person's going to get that money a bit quicker than if they were just a normal nomination.
So guys, someone's listening and thinking, how do I make the most of this? What could they think about doing?
Look, when it comes to super and tax, there's a lot of moving pieces there. I always think probably the best place to start is to make an appointment with someone like myself or a client service manager that can take you through all of the options. So one really simple one may be, can you salary sacrifice to start saving yourself some tax?
And when you make your own personal salary sacrifice or own personal contribution, there are tax savings there as well, aren't there?
Yeah, so that's the way of doing it, by making a lump sum contribution to super and claiming a tax deduction on it. Now, to do that, you've actually got to fill in what's called a notice of intent to claim form. That's got to be lodged with your superannuation fund. You've actually then got to wait until you get acknowledgement of that from your superannuation fund. And really importantly as well, for that tax deduction to flow through to you, you've then also got to put that same amount, the lump sum that you've made, you've got to put that amount in your tax return that you do for that year. Another thing you consider doing is, if you're over 60, start a transition to retirement strategy or open an income stream, and there can be huge tax benefits to doing that.
Guy, can you explain to everyone what a transition to retirement strategy is, or TTR?
Through my years of being a financial advisor, I've seen people use transition to retirement strategy for all sorts of reasons. So what it allows people to do who are over 60 and have reached their age preservation age for super, allows them to begin drawing down from their super tax-free. And people do that for all sorts of reasons. You can do it to reduce your working hours. You might decide you don't want to work full-time anymore. You want to go part-time at Bunnings, but be having some extra income come in as well. A lot of people have used it for being able to salary sacrifice more. So be supplementing your income from your superannuation pension account, but then actually making salary sacrifice contributions from your salary, which will actually save you tax, and also be increasing your super at the same time. I've also seen people simply do it because they want to go on a holiday or they want to pay down the mortgage.
Sounds amazing. I love it, guys. So essentially what you're saying is the TTR is a strategy where people can work less if they want to, and they can supplement their income by taking money out of their super because they're making additional contributions. Is that right?
Yeah, I think just the important thing to think of is with the transition to retirement, if you are eligible for it, it just gives you more options as to what you can do. You can actually start accessing money from your super tax rate, and it might give you that extra financial freedom that you really need. But really important, understand the rules, the caps, the amount you're able to draw down. Really important, you can get that information at Legal Super from someone like myself or a client service manager. We can actually give transition to retirement advice to our members, and that's totally free of charge. You'll find elsewhere in the financial advice industry, you might be paying thousands of dollars for that exact same advice.
Can you explain the $3 million cap? So how's that going to work in practice?
I think the most important thing to remember is just, it's not legislation yet. It's just a proposed tax. It's Division 296, which is this new superannuation tax. And it's actually to be applied as an extra 15% tax just on the earnings of your superannuation fund above $3 million. So it doesn't affect anything below that. And how it is meant to be applied as it currently stands is that it will be worked out on a proportion of the percentage of the earnings on what your balance is above 3 million. So for the vast majority of people, it's actually not going to have an impact. And the Australian Tax Office will take care of all of the calculation of that. And you'll just be given a notice if you do have a liability under it. And you will have the option to pay that from your super balance.
Before we wrap up, and it's been lots of fun, what is the key takeaway that you want listeners to remember when it comes to tax and super?
That super isn't just a retirement account. It's a really powerful tax planning strategy, both for right now and in retirement. So if you understand how contributions, earnings, and then when you come to retire, withdrawals, how they're taxed, then you can start to really use the superannuation system to your advantage, not just for retirement, but for right now. So if you're making contributions to your super, reducing your income tax that puts more dollars into your pocket right now can mean that you're putting tens of thousands of dollars extra into your pocket when you're coming to retire, or even right now because you're saving income tax. But really important to get all of that information, get the level of support that you need. Make an appointment with someone like myself or a client service manager at Legal Super. Those appointments, there's no cost, there's no obligation involved. You can have as many as you like, and there's no limit to what you can do.
Thanks so much, Guy. I know we've covered a lot today and there's been some really valuable insights. Really appreciate you joining us.
Cheers, Jess. All information in this podcast today is of a general nature. please refer to the Legal Super PDS and TMD on the website before making any decisions. And please remember that past performance is no indication of future performance.